Hello everyone, Cory Mitchell here with TradeThatSwing.com, and in this video I want to talk about how to trade your own game so you're not lured into the market's game. So instead of thinking about trading as a endeavor where you need to predict what happens and your results are dictated by how good at predicting you are, think of trading more as where every trade is a relationship. So if you're in a relationship, you're not predicting what this person's going to do and thus deciding whether you should stay in the relationship or not. Rather, it becomes more about boundaries. You know what you want out of the relationship, and then if this person produces those things that you want, you tend to be happier in the relationship, and so you stay with it. And if they are giving you behaviors and actions and dialogue that doesn't fit with what you think a good relationship would be, then we tend to back off. Now with a relationship, you can actually say like, hey, I didn't like that. Maybe you could think about changing that. Or, I felt this way when you did that. With the market, we can't do that. We can't discuss with our trades how we would like them to behave. So it's a very one-way street, but it still requires this ideology that what the behavior your trades give you, you get to decide whether that's acceptable behavior or not. And if it is, then you may continue to hold that trade. If it isn't, then you would get out of that trade. So this makes it much more about what we do. It puts the onus on us as opposed to trying to predict what the market would do. So how this would in a trade is, so I have setups I trade, and we'll talk about how we do our research and stuff, and how that's a little bit different than when we're actually trading. So actually, let's start with how we come up with the idea, and then you'll see the sequence. So outside of trading hours, when there's no money on the line, that's when I study charts. Weekends, evenings, when my trading platform's not open, maybe I just have my charting platform, and I have an idea of how I want to trade. I can research a certain setup. If you're a fundamental trader, like, do low PEs produce good stocks? That might be your idea. Do they produce good trades? And then how would you get into those trades? So you can study the charts, come up with an idea, come up with a strategy. How would you get in? Where would you get out? If it's more of a chart pattern, like a triangle or a rounded bottom, I trade these patterns. I've looked for hundreds and hundreds and hundreds and hundreds of examples of those, and I look through them and I decide, okay, how can I get in at a decent time, but before it really takes off, but also I don't want to get in too early where the market could chop me up. So I'm coming up with these strategies, but this is done outside. So that's the research time. That's where more the game of prediction comes out, if you want to play that game. And it's not so much about prediction, it just becomes about statistics, right? If you've studied hundreds of patterns, I find it ridiculous when someone comes out and says, like, this stock is for sure going up, or those people are idiots, because they obviously have not done their true homework, in the sense that if you had studied that same pattern over and over again, those same conditions, you found those same conditions in other things, and you look for the trades that won and the trades that lost with those conditions, you would find that it's a probability. It may be a high probability, but it's a probability. So nothing is 100% certain. And so we would find that if we found a triangle pattern, that basically your highest conviction could be the percentage win rate that you saw. So after 100, if you analyzed 100 triangle patterns and you found that it hit your profit target 60% of the time, well, then you know that this pattern 60% of the time you're going to be right, 40% of the time you're going to be wrong, and it's a probability assessment. So it's even in the research, there's no certainties. There's no there's some forecasting in the sense that I guess you could say, well, this works 60% of the time. To borrow from the Anchorman quote, 60% of the time it works every time. That's about as good as you can get, right? And there's going to be different probabilities for different setups. You might find one that hits your target 80% of the time. There might be another one that hits your target only 30% of the time, but you make a really big profit on those trades. So that's done outside of trading, this probability assessment. And we can decide, okay, if I trade this position size, I win 60% of my trades. Based on the research I'm doing, it looks like I can put my stop loss here and my targets here. I can make 3 times what I lose. I can make 3 times on my targets versus what I lose. So maybe I'm risking $100 to make 300 or 1,000 to make 3,000, whatever your kind of budget is for your account. And you can factor that out and decide, like, okay, that's a profitable strategy. That is worth trading. That's all done outside of trading. But even it's a little bit prediction. You can see what I'm saying here. But it's more probabilities, because trying to predict with certainty of something is absurd. And we really want to get rid of that notion, because it is not going to help you as a trader. You want to be confident in your method. You want to know that, hey, if I put money on the line here, there is a good chance that over many trades I'm going to make money. But that's over many trades. On any single trade, we cannot predict the outcome of that trade. So that's where we develop strategies and things like that. So in that case, we are studying our charts, we're looking at probabilities, all those kinds of things. Once we've decided we're going to trade a strategy, that is where we start trading our own game, not the markets. So you come across a stock or a pattern, and then now you're going to go back to you're going to know what your research is. You've looked through hundreds of these already, and you're going to look for certain things to emerge. So in your research, this is again outside of trading, you may have found that the trades that really work tend to exhibit certain qualities fairly quickly. If you found that, then you would want to incorporate that into your own mental game, right? So when you go to actually place a trade, I like to think through the trade. I like to plan it out, even if it's day trading and it's like, I'm what I call scenario planning. I'm basically saying, like, I'm taking this trade because the patterns have shown that over many of these trades I can make money, and the ones that tend to make me the most money are ones that exhibit these qualities. So if the market exhibits this quality, I will stay with the trade. If it doesn't, I'll get out. And the reason I might do that is because if it doesn't exhibit those qualities, then there might be no reason to let it hit my stop loss, right? It's already not showing the qualities that I've seen from good trades that I've taken or that I've studied. So there's no reason for me to just lose the whole amount that I put on the stop loss. So, I might put out a stop loss there as my kind of last resort to get out. But assuming because the price might move very quickly against me, right? And you want that stop loss there to get you out. But let's say you enter a trade and the price just kind of meanders and it doesn't really do anything. Is that the behavior that you've seen from these best performing setups when you looked at your strategy? Is that what the best ones did? If it isn't, then I would just probably get out with a small profit, small loss. And that's going to help my overall P&L, at least for me, trading this way. Because, if it just meanders, there's a chance that it's going to hit my stop loss, which is usually fairly close. I like to keep them close because a lot of people don't like small stop losses because they don't want to lose. Whereas I look at it the other way. If I have a small stop loss, that means I can get a multiple of that. So if I have a small stop loss, I can multiply that by 2, 3, 4, 5, and that target's going to be closer. As soon as you have a really big stop loss, you have this, if you have a stop loss this big, and you can make a profit this big, you're going to make 3 times your money. But if your stop loss is this big, all of a sudden the price has to move this much to give you a 2 or 3 to 1 to trade, which is harder in my opinion. So I can get a better bang for my buck having a smaller stop loss with targets that are also smaller, but still a big multiple of that stop loss. So I can make 3, 4, 5 times the amount I'm risking on smaller, more consistent price moves. Whereas if you have a really big stop loss, you need a huge move to hit your target, which is a multiple of that stop loss. Anyway, getting sidetracked. So I like to have small stop losses. That's just my personal preference. So if the price pretty quickly isn't exhibiting what I want, I instantly go on high alert because I have these boundaries that we talked about, right? I want to see my trades following the scenario that I've seen from the best trades that I've studied. If it's doing that, I stick with it. If it's not exhibiting, then I tend to get out. So on a lot of my day trades, you'll see some early exits before my targets, and that's because the price was showing me something that I did not like. It was not the high quality movement that tends to occur in the winning trades and the trades that move very quickly toward the target. So in a way, once I'm in front of my platform, it's no longer about I wonder what's this going to do, I wonder what this is going to do. That should have already been done. That's done outside of trading. That's strategy development time. So you have 2 different times of your day. You have your strategy development time, which is done outside of trading, and then you have your trading time. And in your trading time, the focus is trading your own mental game. Are the trades within your boundaries that you want to see? So I think of each trade as like a little relationship. Is it doing what I want it to do? Okay, I'll stick with it. If it's not, I'll get out because I can't negotiate with it. Then I can, of course, take that data. You should be, I don't do it as much anymore, but early in my career, I would just have stacks and stacks and stacks of like notebooks from the day, writing down my thoughts, my emotions, mistakes I made, things that worked really well, things that didn't work well. And then you can take that information in and then incorporate it into your strategy sessions and say, like, I seem to struggle with this area. How can I improve it? I've noticed that, like I was talking about before, you might notice certain little things. If this happens right after I get into a trade, it usually doesn't work out. So I could probably trim some losses there. If we start doing that, then all of a sudden our P&L goes up because now instead of taking full losses on those trades, maybe we're only taking a tiny loss or even a tiny profit. So we can start fine-tuning these things. So it's not just, we came up with an idea and we're stuck with that forever. We should be taking that information and incorporating it into our strategy development. And then once we are in front of our computer, we're taking all that information that we've written down and our strategy, or it might just be in our heads, and we're incorporating that into live trading and saying, this is what the best trades have done. This is what I want to capture. and super strict boundaries. And if we can incorporate that, all of a sudden the game changes, because a lot of people are just so frustrated that, you know, they get into trades and they get stopped out, and it's like the market's after them. You know, we hear this a lot, like, I get in, I get stopped out, and then it instantly goes the other way. If we were to take all that information in, let's use that example. You constantly seem to get in, get stopped out, and then the price goes the direction you want it to. How could you use that information? The market's telling you something, but most of us are too stubborn or too upset to notice it. But that's a timing issue. You're in too early. You are, and most people do the opposite. They'll say, it's not me, I just need to give it a bigger stop loss, or something like that. But it's not the size of the stop loss that's really the problem. You could actually probably even reduce the stop loss size if you get your timing right. So you're entering too early. And there was times early on in my day trading career when I found I was just getting in a little bit too early. And I had like little rules. Like sometimes I would just wait like 1 second. I'd want to get in, and obviously my results weren't as good as I wanted them to be, so I was just getting in a bit too early, and I had to hold through these like gyrations, and then it would go, and or just one more price bar. You know, there was like these little things, and I just realized like it wasn't so much about the market was doing, it was that I looked at my own results and I said, something's off here. Like the strategy seems to work, the price seems to go that direction, but for some reason I'm getting stopped out before it happens. And you know, you can analyze all sorts of things, but when it came right down to it, I was just a little bit early. So when I saw the signal for me to get in, I just waited a little bit, and all of a sudden my results dramatically improved. And it sounds so stupid because that's more to do with me than what the market, but everyone thinks they have to trade the market. But if you look at your own results, your own trades, then you can realize what you're doing, and then you only have to fix your own behavior. You can't fix the market, you can't control the market, you can't even predict the market. So why is this obsession with most traders about always, you know, they're looking at the market for answers, when really we should be looking at our own trades, our own results for our answers. And this also goes back to trading your own game, your own mental game. And so I view it more as, you know, I just look at what I'm doing and I analyze that, and how could I do what I'm doing better? So it's less about studying the charts. You know, you once you have your strategy, it's more about analyzing yourself and your results as opposed to more and more market study. So this is how, another way we can trade our own mental game. And you realize that all of a sudden it takes the market's control away. It is entirely in our own hands, and we can trade any way we want. You don't need to have a whole bunch of other people's voices in your head telling you what to do. Maybe you've seen my courses, you've seen other people's courses, and all this information's in your head. But if you've also taken my courses and the videos, which I'm sure everyone seems to skip because no one ever asks about them or seems to incorporate them when I talk to them, but there's a video in every course on improving your own results. And this just seems to be completely dismissed. I think because most people think they have to predict the market to make money, when I'm telling you the exact opposite. You can look at your own behavior and change your own behavior based on what you're seeing in your results, and that will give you different results. So there is an article on this on the website. There's a whole bunch of articles like this. If you go to tradethatswing.com under trade improvement, there's an article called Trade Your Own Mental Game, and it's basically talked about what we have talked about here. and it includes some, links to things that you might like. I had briefly mentioned scenario planning, so there's articles in there about that you can click on to dig a little bit deeper. And this is the main takeaway. Once I'm trading, there's no thinking about where the market will go. My only focus is the price doing what I expect it to do from my research? If it is, great. It has to, the price action after the trade, once the trade begins, has to match my internal view of what I want the market to do. So it's about me. I have the control. If I want it to go up and it doesn't, it's not doing what I want it to do. If whatever strategy you trade, if it's not adhering to that, then it's not giving you the thing you want. So I form an internal projection of what I think what I want the price to do based on this setup, and then, like a relationship, it either gives me what I want or it doesn't. And to me, I find this just takes a lot of the crap out of the picture about everyone giving different opinions about what price will do. Who cares? Like I publish a weekly outlook, but it's simply based on current conditions and what that means what I'm doing in those conditions. And it's if the market's doing something I like, then I trade. If it's not doing something I like, I don't trade. And it's more about me. I'm not making any predictions. I'm not saying, we're flying higher from here. Nobody knows that. And if they do, they should be giving you a probability with it, right? Because if they're saying, we're going up, then based on that, there should be a probability assessment with that, because you can't, we don't know something's going up for sure this time. All we can know is that when this pattern's occurred, if we've studied it, maybe 30% of the time it goes up, or 50% of the time, or 70% of the time. If there's conditions I don't know, then we stop trading. So that's an important one too. You're going to come across times where we don't need to be in the market all the time, right? So there's going to be times when you're trading, and most of us, we're traders. We want to be in the market. We want to trade. We want to put our capital at risk to potentially make more. And there's times where we see patterns that we know and that we can risk our money on, and there's going to be other times where we're just kind of like, whoa, like, what's going on? And I don't just gamble. We don't want to gamble. That's the market luring you into its game, where all of a sudden you don't have any boundaries anymore. You're saying, you know what? The market's doing this, and I'm going to try to predict what it's doing and put some money on the line. And that's the market's game. That's what the market wants you to do, because that means your money is going to flow into someone who knows that situation, and they're going to take your money. If you stick with the conditions that that you have an edge in, this goes back to the strategy development, and you've been working on looking at your own trades, your own results, improving those. If you stick to that, then you have the edge, and money tends to flow from the traders who don't know what they're doing in those situations. You do know what you're doing in those situations, and the money flows to you. But as soon as you enter an arena you do not know, your money flows to the traders who do know what to do in those situations. And with millions of traders around the globe, there are people who tend to be better at certain patterns, certain situations, certain market conditions compared to others. So there's always going to be someone who's better than you at certain situations, and your money's going to flow toward them. You're better in certain situations, money will flow toward you. Kind of as a cumulative, you could think of it. Because, it's not just you versus one other person. There's thousands of people trading, in any given minute in an asset. So, the people who know what they're doing are generally taking money from the people who don't know what they're doing. And then when the conditions change and these people know what they're doing in those conditions, these people, if they keep trading, the money's going to flow toward them. So, it's like a group or a team. People who know what they're doing take the money from people who don't. So if this was interesting, you can check out the article for a little bit more insight. But hopefully some information there on how to change your view of the market so that it's more about you. You're not as concerned about what the market does, and really puts your results in your own hands as opposed to just hoping that the market does what you do. When you have boundaries, you can put your money on the line. I found this is really interesting. Someone told me if you don't have boundaries, you can never get close to anyone because you'll be afraid they hurt you. So that has to do with relationships. But the same goes for trading. If you don't have boundaries, you will never be a successful trader because you can't put your money on the line because you can't trust what the market's going to do. So how I think of it as, I put my money on the line. If it does what I want it to do, great. It starts making me money. If it doesn't do what I want it to do, I just get out and I limit the damage to myself. This allows good traders to continually put on risk and not get so emotionally damaged and their capital damaged as well, because they can get close to the market. They can have a relationship with all these trades and not be so attached to them, because it's just, it didn't do what I want, done. It didn't do what I want, done. Oh, there's one. It did what I wanted. Great. But if you go in with this idea that you have to predict and it doesn't do it, and you're like, man, like I just never seem to get it right. That's a totally different mind frame than just looking for the ones that do what you want. And when they do that, that's how you make your money. And when they don't do it, you just cut it quickly, and that's how you save your money, your emotional capital and your physical capital. So just think about that, trading your own mental game, and as opposed to getting lured into the market's game.